This video will demonstrate a cost flow assumptions example where we will calculate cost of goods sold and ending inventory using the first in, first out, last in, first out, and average cost flow assumptions. I am basing the example on the handout. If you look on page 14 of your handout, you have an example number 5 for Swift Company. So what we can see here is that Swift Company has some beginning inventory and a few purchases. So on January 1st, 14, there's beginning inventory of 100 units at $10 per unit to give a total cost of $1,000. Then on April 15th, Swift Company had purchased 200 units at $12 a unit to give a total cost of $2,400. And then finally, on August 24th, Swift Company purchased 250 units at $13 per unit to give a total cost of $3,250. This then gives Swift Company a total number of units available for sale of 550 and a total cost of goods available for sale of $66.50. During the year, Swift Company sold 400 of those 550 units of inventory. So if they sold 400 units, it must mean that 150 units are left behind in their ending inventory. Now the question is, what are we meant to be doing with this information? Well, we are trying to calculate using the cost flow assumptions of Fifo, Lifo, and average cost, the cost of goods sold under each of those three assumptions, and the ending inventory under those three assumptions. So to begin, let's set up a workspace where we can calculate these numbers. So what I've done here is set up a page that has the FIFO cost of goods sold as a heading. I'll look at the units sold, the cost per unit, and the total cost. You can follow along using a similar methodology or your own methodology as long as we get to the same end result. I also made a space to calculate FIFO ending inventory, the units left, cost per unit, and total cost will give us an ending inventory balance. So now going back to the question, we are reminded that 400 units were sold and 150 left. And this will be the same number of units for each of the methods. It's just that based on the method we are using, the number of units will be the same, but which units were sold will be different. So what do I mean by that? Well, when we use the first in, first out method, what we are saying is that we assume, remember this is not necessarily a fact, we assume that the first units to be bought are the first units to be sold, which means that if we sold 400 units under FIFO, we would begin to look for units sold from the earliest date. Whereas with Lifo, if we sold 400 units, we assume that the last unit in, which means to be bought, is the first unit out, which means to be sold. So under Lifo, we would assume that the 250 units on August 24th were the ones that were sold first. Under average cost, we have a totally different approach, and I'll demonstrate that for you later on. So let's begin with FIFO. So under FIFO, we want to know which units were sold, what's the cost per unit, and so on. It would be easiest if we also put a column here for the date. Right? So remember we said that with FIFO cost of goods sold, the first unit in, which means to be bought, is the first out. So that would mean that our units from January 1st, 14 would be sold first, and that's 100 units at $10 per unit. So we multiply that out to get the total cost. We need 400 units, so thus far we only have 100, so we move on to the next date. So 415, we have 200 units, we need all of those units, and it's at $12 per unit, so we multiply that out to get to 2,400. We're not done yet, right? Remember the question told us that 400 units were sold and we only have 300, so we need to move on to August 24th. But yet, August 24th, we run into a bit of a problem because it says that there are 250 units from that date, but we only need 100. So all we do is we take what we need, which is 100, and the unit cost stays the same. Notice that even though we only took 100 units out of the 250 batch, the unit cost remains at $13 per unit, and that's because the price is per unit, not for the whole batch. So that gives us 1300. When we add up, you notice that we have 400 units exactly. Be careful, you have to stop counting at 400 because that's the number of units that were sold. We do not add up the cost per unit because that's per individual unit, but we will sum this total cost, and this will represent the cost of goods sold for our income statement. Remember, cost of goods sold is an expense that we recognize in the income statement. So again, under first in, first out, cost of goods sold, we look for the earliest units and assume that they were sold first, and we only count up to the number of units that were sold based on what the question tells us. Going back to the question, we now have to calculate ending inventory for FIFO. We kind of know how that works because we took 100 units from August 24th, which must mean that there's still 150 left from that same date. So we put in the date. It can't be January 1st because we sold all those units. It can't be April 15th because we sold all those units. The only date where there are still some units left is August 24th. And so it must be the 150 units from that date at $13 per unit, which will represent our ending inventory. So this is ending inventory, which goes to the balance sheet. Remember, inventory is an asset. Now, how do we know that we've done our work correctly? Well, firstly, the units sold plus the units left should equal back to 550, which is the number of units we had in total. And then the total cost of goods sold and the total ending inventory together will equal 6650, which is the total cost of goods available for sale. So that's how we cost out cost of goods sold and ending inventory using the FIFO, or first in, first out method. It doesn't matter which order you calculate in. In other words, you could do ending inventory before you calculate cost of goods sold. That's fine. And in fact, that may even technically be more appropriate, since in the real world you would have the ending inventory left behind at the end of the year. However, it's more intuitive to calculate cost of goods sold first because the FIFO method is actually describing how goods are sold. The first thing to be bought is the first thing to be sold. Let's move on to Lifo. So again, I'll just insert date here. So Lifo cost of goods sold, we still have the same headings as before, but now we will have to use a different approach. Remember, it's still 400 units, but the units that we take are going to be different compared to FIFO. So 400 units are sold, but Lifo says the last thing in is the first thing to be sold. So that means we have to start with the 250 units on August 24th. So we start at the bottom and we take our 250 units, and you remember that it was $13 per unit, so 250 times 13, right? So we need 400 and we have 250, so we still need to go further. On April 15th, we have 200 units, but we don't need 200, we only need 150. So we'll take what we need. And the unit cost over here was 12. It doesn't change even though we split the batch up. And we are going to multiply this out. So let's check to see if we have 400 units. We do indeed. And the cost of those units is 50/50. And this too is going to be cost of goods sold for the income statement, but under the Lifo method. What do you notice about FIFO versus Lifo? Do you see that the cost of goods sold under FIFO is lower than the cost of goods sold under Lifo? We'll talk a bit more about that later. So now we need to calculate our ending inventory under Lifo. Well, we can kind of guess what's left behind, right? Because if you remember, we took 150 out of April 15th. So when we go back, we know that there's 50 units left over in April 15th and also 100 from January 1st, which makes sense because remember, we're looking for 150 units. So it doesn't matter which order you list the units in. I'll just put April 15th because we know that there were still 50 units left from that date at $12 per unit. And then we also have January 1st, 100 units at $10 per unit. So together, these make up the 150 units that are left behind, and we also sum them to get to 1600. This is going to represent ending inventory in the balance sheet under Lifo. So how did we get there? Well, we said what's left behind. We sold everything in August. We sold 150 of the 200 units in April, so it must mean that 50 units are still left. And the units from January 1st were never sold, so they will still be left behind in our ending inventory. We check our work to see that yes, we did account for the 550 units, and we also know that we did account for 6,650 in costs, because when we add cost of goods sold and ending inventory together, we come out to 6,650. So again, main difference between LIFO and FIFO is that when we are calculating the cost of goods sold, FIFO assumes that the first units to be bought are the first to be sold, whereas LIFO assumes that the last units to be bought are the first to be sold. If you think about LIFO, you can perhaps think about a technology company, or maybe you can even think of a fashion house. The things that come in last are the ones that are sold first, right? Especially if you think about phones, everybody wants the latest gadget. So LIFO is like the last things in, people always want first. Whereas FIFO, if you think about the first thing in is the first thing out, you might think of a restaurant. They are always trying to use up the produce that they bought first, or a supermarket is always placing the produce with the closest expiration dates in the front, because they want the first thing that came in to also be the first thing that goes out, so that they don't lose too much on their purchases. Now remember that I'm giving you practical examples of how this might look, but a company doesn't have to be a restaurant to use FIFO or a tech company to use LIFO. They can assume any method that they want to. The final piece that we have to look at here is average cost. Now, average cost doesn't depend on dates like LIFO and FIFO. In fact, average cost is slightly simpler than LIFO and FIFO. We have 3 steps in our average cost calculation. The first step is where we actually try to figure out what the average cost is per unit that we unit of inventory that we have. So what we do is we look at the total cost of all the units available for sale, and we'll divide that by the total units to get an average cost per unit. So we are going to find the total cost, that's going to be the 6,650, and we're going to take the total units, which will be the 550, excuse me, and then we will say 6,650 divided by 550, and we say, oh, that gives us 1209, right? So 6,650 divided by 550 gives us 12.09. So that's the average cost per unit. And what we'll do in the second step to calculate our cost of goods sold is we ask how many units were sold, and we know from the question that 400 units were sold, and we take our average cost per unit and multiply 400 units sold times the cost per unit gives us 48.36 cost of goods sold. So this was 400 times 12.09. I rounded the 1209. And then finally, for ending inventory, you are going to take the units left, which is 150. We've calculated that before, and we are going to take the average cost per unit, and we are going to multiply out the 150 times the average cost per unit. So 150 times 1209. That's going to give us the ending inventory for the balance sheet. So notice how we are not using dates or anything in first or out first. We are simply taking taking 3 steps. Total cost divided by total units gives you an average cost per unit. That average cost is then used to multiply by the number of units sold to get to cost of goods sold of 4836. It is then also used to multiply by the units left to get you an ending inventory of 1814. Be very careful here. Average cost is separate from FIFO and Lifo. It's got nothing to do with FIFO and Lifo. And also, average cost should be able to be checked. So you can see that you have 550 units and you also are close to 6650. There may be sometimes some rounding errors, but we should come out to the same. Remember, that's all we had to allocate. So even if there's a rounding error, you should come out close to 6650, if not exactly 6650. So those are the 3 cost flow assumptions. A company can choose any one of these cost flow assumptions. The one caveat though, if a company chooses Lifo as its cost flow assumption, it also has to show in its financial statement what the numbers would have been if it had used FIFO, and it does that through something called the Lifo reserve. We are not yet done with the question because there's a part B and a part C. In part B, we are asked which cost flow assumption results in the highest cost of goods sold and why. So going back to our numbers, we can scroll through and we see that FIFO's cost of goods sold is 4700, Lifo is 5050, and average cost is 4836. So clearly Lifo has the highest cost of goods sold. Just a tip for you here, if we are being asked the highest or lowest cost of goods sold or ending inventory, the answer will never be average cost, because average cost always ends up in the middle between FIFO and Lifo. So the answer will either be Lifo or FIFO when you are being asked for the highest or the lowest of cost of goods sold and ending inventory. So for our question, the highest cost of goods sold is Lifo. And the question also asks why. Now, this is where you have to be careful, right? You can't say it's the highest because of the number of units sold. Remember, all of the assumptions have the same number of units, but what does happen with Lifo is that there are more of the later units with a higher unit cost. So that's why it has a higher cost of goods sold. So Lifo is the highest cost of goods sold. So Lifo has the highest COGS because it includes more of the latest units with a higher unit cost. So that's our answer. Let's look at C. It says which cost flow assumption results in the highest ending inventory. So again, we scroll through and we say, okay, FIFO ending inventory 1950, Lifo ending inventory 1600, average cost 1814. So it looks like the winner is FIFO. So FIFO's ending inventory is 1950. It also has 150 units. So the reason for this, the high ending inventory, is not the number of units, but the unit cost. So we write that FIFO has the highest ending inventory because it includes more of the latest units, keep doing that, with a higher unit cost. So notice how the answer sounds kind of the same, but remember we are dealing in B with cost of goods sold and in C with ending inventory. So I'm not going to continue with the rest of these examples. You'll be able to do them based on this example that I just showed you. But what I do want to point out in number 6 is that we are given information in a slightly different manner compared to the previous example. Here with a chance company, it tells us that 200 units are in ending inventory, whereas with Swift company, they told us what was sold. So 210 units are left out of 750, which must mean that 750 minus 210 is 540. That is what was sold. So when you are calculating cost of goods sold, you should be basing it on 540 units, and when you are calculating ending inventory, you should be basing it on 210 units. I'm sharing this because it's a common error to just look at the number of units that are given and just assume that that is what was sold. The tip here is that the number of units sold is normally a bigger number than what is left behind because most companies are trying to make a profit. One final bit of advice is to remember that there is an interaction here with cost of goods sold and the income statement. Cost of goods sold is an expense, right? So cost of goods sold is an expense. And the higher our cost of goods sold, the lower our net income. And lower net income equals lower taxes. So one of the reasons why companies often use Lifo is to try and get their tax bill to be lower. What's interesting is that billions of dollars are in cash tax is saved by companies every year because of using Lifo, even though it's only a cost flow assumption. When a company uses Lifo for the purposes of tax, it also has to use Lifo for the purposes of accounting. So, Lifo does sometimes lead us to questions asking whether it's fair because companies are actually getting a tax break based on an assumption that isn't reality. But we'll talk more about that in a future class.